If you have a Demat account, I am going to save you crores of rupees, and that is because today we are in a history lesson, and this lesson teaches you about the biggest bubble in the history of the stock market. Pay close attention because you are going to learn how to identify these bubbles so that you can stay protected in the event of a large crash. My name is Aditya Iyengar, CFA, and today I am tasked with the responsibility of making sure that you understand all about the 2001 stock market crash, which was famously known as the dot-com bubble. So there's a saying in the stock market which goes something like this: the bigger the bull market, the poorer our memory about the things that happened in the past. I have a question for you. If you see the Nifty 50 grow by 300% in a year, would you still continue to invest in it? I'm sure at the outset you are like, obviously not. That is so unrealistic. Who would do that? That's definitely a bubble and a big crash is coming. But here's the reality, you would. 100% I can bet on it. And why do I have this conviction? Well, that is because between 1997 and 2000, millions of people continued to pump money into the Nasdaq index in the US when it grew by 300%. And that is why I say that you would totally invest more and more of your hard-earned money in the Nifty if it were rising like the Nasdaq. Because that's what happens in a bubble. We are riding on the euphoria. And then what happened? The Nasdaq crashed by almost 75% in the next year. That is what it means to be in a bubble, and that is why I say with conviction that you too would invest loads of money in the Nifty if it were rising like the Nasdaq back in 2001. In this video, we'll learn how the world failed to identify one of the biggest bubbles in the stock market, and pay close attention because you will learn how to identify one in the stock market in the present day. So let's go back to the 1990s. There was a web browser called NCSA Mosaic. This was one of the first publicly available browsers that was easy to access, and this time slowly more and more households were being exposed to the internet. 1991 was a time where it was possible to browse the web on NCSA Mosaic at a speed of 14 KB per second. Now this seems like barely anything in the era of 5G, but understand that back then it was a huge deal. This was a time when the internet was not even a thing. Sending emails and texts over chat room was a big deal. Between the years of 1990 and 97, the percentage of American households with access to a computer grew from 15% to 35%. During the same period, the average internet speed went from 14 kbps to a whopping 256 kbps, a jump of 20x. Now I'll tell you why this was a big deal. In 1995, a group of entrepreneurs became extremely rich because of the internet. You remember NCSA Mosaic, the first ever widely available browser? It was created by a company called Netscape, and they went public via IPO in the year 1995. And guess what happened? The company hadn't earned a single dollar in profits, and in spite of that, it went 3x on listing date. And all of this happened within 16 months of being founded. In less than 1 year, the valuation of Netscape went to $2.9 billion, and people realized something. The internet comes with a lot of hype, and if you wanted to make money, you had to start something related to the internet. So up until this point, an IPO was for a mature company. Once a company was well past its growth stage and was maybe trying to raise some capital to start another venture or another segment, they went for an IPO. But after seeing what happened with Netscape, a company with literally no profits and a near $3 billion valuation in the IPO market, entrepreneurs realized that you just needed to make something remotely connected to the internet if you wanted a successful IPO. Because of this, in the late 90s, a trend started in the US. Any company with either .com or web or any internet related term in its name was easily able to access capital and go for IPO. Many times without profit and sometimes even without any revenue. Founders felt like this was a cheat code. There was a company called 360 Networks. It had a market cap of $13 billion, and just in a few months of reaching this market cap, they filed for bankruptcy. Why? Because they had no business. So if you look at the present day, many times there is hype for an IPO if that company has revenue growth. But back then this hype was for growth in another metric: web page clicks. The more clicks or hits a company's website had, the more it was deemed to be worthy of investment. And guess what these companies did? They spent millions of dollars at a stretch so that they could get these clicks and quickly go for IPO at a premium valuation. There is absolutely no business, no profits, sometimes no revenue, but there are a ton of web page clicks and every company was selling itself like the next big thing. I'll give you an example. There was a company named Boo.com and they spent $188 million on marketing and fancy parties for tech bros, and they filed for bankruptcy soon after. But wait a minute, the bigger question needs to be answered. Where was this money coming from? The answer is venture capital. So venture capital is basically an arm of investment where a group of extremely wealthy individuals come together and they decide to invest their money in extremely early stage businesses. Their model is very simple. Let's invest a ton of money in a ton of companies and hope that at least 1% of them succeed. And that's exactly what happened. A VC would come along with a bunch of extremely wealthy investors, maybe put their money into 1,000 companies and hope that at least 10 of them get to the IPO stage and make them all of their money. The only hope in this case was that the 10 companies that get to the IPO stage recover all of their investment and beyond. And you need to understand why this VC ecosystem is so important to understand the growth of bubbles in a stock market. So up until 1997, the average IPO return in the US stock market was around 15%. But do you know what this number was after 1997 for internet companies? A whopping 90%. Meaning you could apply for an IPO and more often than not, on average, you would double your initial investment. Now you need to understand that oftentimes heightened VC activity preludes a bubble. If venture capital is deploying a lot of money in the markets, then we might be in a bubble. And I say this because the macro environment of the US back then had some interesting things to show us. So back in 1997, the interest rates were very low and it didn't make a lot of sense to keep your money in a fixed deposit or in your bank account. So this incentivized people to invest their own money elsewhere. Additionally, there was a new law that was passed called the Taxpayer Relief Act in the US, which lowered the taxes on capital gains, meaning any money that you make from your investments would be taxed at a lower rate. So when interest rates were low and everyone was investing in stocks and the capital markets, it was an extremely conducive environment and raising money via venture capital became very easy. Additionally, there was another catalyst. The Telecommunications Act of 1996 was a law that stated that any person could come in and start an internet business. The government deregulated that space. So what happened? Venture capital was pouring money into startups. These startups were using that money for marketing and getting more and more clicks and eventually going for IPO, and everyone was making a ton of money. At this time around, the chair of the Federal Reserve in the US, Alan Greenspan, even warned that this spending is a little excessive and we need to be a bit cautious. However, at that time, he didn't really care to raise the interest rates. Now you remember that thing I said about the Nasdaq where it grew 300%? Just 3 days after the Nasdaq hit its all-time high, Japan announced a recession. And there were a lot of internet businesses and software companies in Japan. And from this point on, where the Nasdaq's price to earnings ratio was literally 200, panic selling began. For context, the Nifty 50's average PE is just 25. That is what indices often trade around. Point being, anything in the 3 digits for an index is very scary. And then what happened? Almost 22,000 jobs were lost alone in the US. Now, typically, a bubble does not mean that it is all bad. There were a lot of companies such as Intel, eBay, Amazon, Microsoft, which survived 2001. After the crash, many internet companies were suffering from overcapacity. They had paid a lot of money to build the infrastructure to run the internet, and now there weren't a lot of takers for this infrastructure. And then guess what happened? The prices for internet dropped and it became democratized. More and more people had access to the World Wide Web. Around 99% of all internet related businesses failed except for those that had a sound business model. But wait a minute. Doesn't all of this sound a little familiar? For example, the SME IPO hype that we are seeing in India right now. A company with just 2 automobile showrooms got bids worth 4,800 crores. For context, that company barely required just 12 crore rupees in capital. On the other hand, look at the Bitcoin hype that we saw in the past 3 years. Before 2021, every single person was trying to convince you that Bitcoin was the next big thing. But between 2021 and 2024, we saw its value crash by almost 72%. Now, before you leave, listen to this shocking thing about the Indian stock market. Our markets have grown by north of 30% in just the past 1 year. Do you think that we are in a bubble? Let us know your thoughts in the comments below. And if you found this video valuable, subscribe to Personal Finance TV.